And so I think in some ways this is like a Big Bang 2.0. And maybe the Genius Act might be looked back as Bretton Woods 3.0 because you now had the capacity to finally democratize access to central bank money. Central bank money is cash in your pocket. There's no real liability to cash in your pocket. There's no counterparty risk. You have it. It's issued by the central bank.
This episode is brought to you by Uphold, which is a great crypto platform that makes it easy to buy, sell, and stake crypto assets. Uphold has over 300 plus cryptocurrencies, including Bitcoin and all the top altcoins, and they offer a crypto staking on over 19 crypto assets. I've been a user of the platform for many years. They are safe and reliable. They don't commingle or lend out your crypto funds, and they are 100% reserved. You can review their transparency report. Uphold also offers an amazing rewards program where you can earn up to 5.25% on stablecoins. This rewards program also allows you to get 24-hour early access to new tokens that they list. And to participate, you just simply have to open the app once per month, deposit $50 once per month, and trade $50 once per month. And the stablecoins that they support includes Ripple's RLUSD. You can earn up to 5% on that stablecoin and 5.25% on USBC. So if you'd like to learn more about Uphold and all the great services they offer, visit the link in the description.
Hey everybody, welcome into the Thinking Crypto podcast. I'm your host, Tony Edward, and we are recording at Station 3 in New York's Financial District. And my guest today is Charles Cascarilla, who is the co-founder and CEO of Paxos. Charles, great to be doing this in person with you.
Yeah, likewise, great to be here.
Charles, we've spoken 2-3 times over the years under some dire circumstances with the previous administration, and now it's a brand new day. And I'm really excited to dive into stablecoins, what Paxos is doing, what the Genius Act means for the market, and much more. But how are you doing?
I'm doing great. It's certainly a new day.
Yeah.
It was grim there for a while, but things have taken like a whole 180-degree shift here, and it's awesome to really see this new environment unfold.
Absolutely. Now, I know you're usually based in Miami, and now you're up in New York. So it seems that business is good. Your phone is ringing off the hook maybe with the Genius Act passed.
Our business has two different aspects to it. One is a regulated custodial infrastructure business, and the other is the issuance and stablecoin side. And to be honest with you, both have dramatically shifted. I mean, if you came in from another planet, you wouldn't believe what our pipeline looks like compared to 6 months ago.
Wow.
And part of that's because every financial institution now wants to think about how can they use a custodial infrastructure product to maybe launch crypto buy, sell, hold.
Sure.
Which we have done in the past for firms like Mercado Libre or Interactive Brokers, PayPal, Venmo, Nubank, et cetera. And so lots of financial institutions are looking to launch because they recognize that the crypto asset class is something that is not going away. It's not going to be prevented, and they need to make that asset class available to their customers. And how can they do that, and how can they do that quickly? Customers like Charles Schwab and Morgan Stanley, potential customers, have been out talking, about how they want to do this. But every large financial institution is thinking about, well, how can they play catch up here? How can they make their either private clients or their retail clients have access?
Sure.
And interestingly, maybe their institutional clients is a little more of a lag. And that's the infrastructure side and on crypto. And of course, on stablecoins, you have lots of different firms from Stripe to PayPal to MasterCard and Visa who are trying to think about how can they enable stablecoins. And a lot of time they want to use a regulated wallet for that. And that's what we're providing.
Sure.
And then on the other side, the issuance side is what was impacted by what you were talking about, which is Genius. And that's definitely shifted the landscape because now it has created a legal framework, not just a regulatory framework or a guidance or policy. It's now created a legal framework. And that's really a different level of certainty than has ever existed before. Of course, you've had that in Europe.
Sure.
It's not really quite as user-friendly as what happened in the United States. And it's unlocking, I think, a huge wave of innovation that was already building. The adoption curve for stablecoin was happening before the legislation, but you're now just getting a huge turbo boost rocket behind it to keep pushing it. And we think the Genius Act is a really good piece of legislation because it's setting the standard that we already set.
Yes.
And I think we've talked about this in the past.
Yes.
We're a regulated issuer.
Right.
And that means that we are issuing from a financial institution. We don't just have licenses like money transmission licenses like Circle or no real licenses like Tether. We have a set of licenses that match what the Genius Act has already set as a standard, which is a financial institution, a trust company where they are able to issue out of. And actually, we have it in many different jurisdictions, not just here in New York, but also in Singapore, Abu Dhabi, the EU. And so that's quite unique. And that puts us in a position to really have a lot of great conversations because firms are trying to figure out, well, what should they do for their stablecoin strategy now? Should they go issue a white label stablecoin like PayPal did?
Right.
And we have issued, really the most successful white labels in the market. And so lots of firms are thinking about it. And we've also, we're always issuing this infrastructure as white label products, or whether it's our wallet or on the issuance side. And when we issue for PayPal, it's their name on it. They go to the market. We do everything underneath the hood. And we also have issued for the Global Dollar Network.
That's right, yeah.
We issue the Global Dollar, USDG. It's a little bit different than a pure white label where it's just one person's name on it.
Right.
This is more brand agnostic Global Dollar. And it has about 68 firms that have joined it now. There's a couple hundred more in the pipeline, so it's growing quite rapidly. And that's everyone from MasterCard to Robinhood to WorldPay to Anchorage and OKX and Kraken, just lots of different types of crypto firms that are involved, and fintech firms, and of course payment companies. And I think you'll see some banks and brokers join as well. And the unique model there is that it's a federated model. Everyone can join. It's open to anybody, and anyone can earn the economics.
Hard question. Which model do you think ends up winning, that network participant where you kind of have more distribution, or the single issuer, or there's room for both?
I think there's probably room for both. I think how the stablecoin market evolves is really an open question.
Sure.
I think there'll probably be thousands of stablecoins, just like there are hundreds or even thousands of prepaid cards and loyalty reward programs.
That's true.
And so, when you have low-cost programmability, you're going to get, I think, diffusion, and you're going to get dispersion. But I think there will still only be maybe at least 2, as many as 5 large stablecoins. And I think it could certainly be a white label stablecoin. And I think it could certainly be maybe something that looks like more of a consortium stablecoin like USDG. Of course, there's also Tether and Circle out there. I think there's advantages to the white label model, which is that you have a single firm that's issuing it. And so they can put their weight behind it. They can make it their focus. They can say, this is our top goal. And when someone does that, it creates a huge amount of leverage and results. The downside of a white label model is it has your brand on there. And so there are competitors, no doubt, to you. And when there are competitors, will they feel comfortable using your stablecoin or not? And so how much does the benefit of having a single firm that's focused lean against or outweigh the fact that you're going to have like some tension there with other companies or other institutions that will look at it competitively? I mean, it's certainly something that can be overcome. USDC is an example of that, where most of the economics go to Coinbase.
Right.
Although I'll tell you that in the case of USDG, part of the galvanizing influence has been many of the firms who joined didn't really feel like they should do a white label, but they found it, and they continue to find it intolerable to be paying Coinbase, right? I mean,
for distribution.
Yes,
Yeah.
I mean, if you go down the list, essentially Coinbase is earning about 65 or 70% of the economics from USDC.
Right.
And everyone knows this. There's no secret here. It's the public how the economic relationship is set up there. And so if you're an exchange that's competing with Coinbase, or by the way, a chain or a wallet or you name it, because a payment company, they kind of do everything. It's a really difficult position to be in, where essentially your business activity is funding your competitor.
Yeah.
It would be like, Bank of America paying JP Morgan for Bank of America's own deposits.
Right.
Right. I mean, how long would you want to live with that for?
Right.
As little length of time as possible.
Sure.
And so that's a difficult position, but yet USDC has flourished, even though that means you're funding a competitor. So that means a white label model could certainly work. Sure. But I think people are a lot more sensitive to the fact that certain types of activity might end up putting you in a more difficult competitive position. And so whether, by the way, it's the USDG consortium, there are a couple bank consortiums that are out there. There's a global bank one. There's the Zelle banks that have talked about this. There's a lot of incumbency in the financial system, and they could easily weigh in a way that could be very determinative.
So on that note, we've heard from Bank of America's CEO, they want to launch a stablecoin, Citibank as well. What do you think with their stablecoins? Do you think it's more within their banking rails, or are they going to try to push that in the open market to have retail use it?
It's very interesting, not talking about any one firm in particular, but I would say generally the largest firms don't want to launch their own stablecoin. There's still a little bit of uncertainty. There's still potential brand risk that they perceive from maybe having their name on it, as opposed to using something that might be a little more abstract, like an Acme dollar, right? Yeah. And so, they might want to launch their own stablecoin within their own ecosystem, and have it be part of a common rail that everyone else might be using, as like the Acme dollar or whatever it might be, or it could be USDG or some different mechanism. We've seen examples where firms come in and say, we have our own UI. We're going to call it, the Tony dollar in the Tony ecosystem because we control that. But it's really just USDG. We just put a new name on it.
Interesting.
And then, when they want to send it out, it gets sent out as USDG. It keeps USDG under the rails. We don't have to do anything, so we can just have our own name on it in our ecosystem. Nothing changes. And if they even want to withdraw it as some other stablecoin, they could too. And so it could be a building block. You could do a white label. You could, of course, join a consortium. So there's many, many different ways to mix and match here, because you're really getting into programmability, and that cost of that programmability is actually not that high. It's much higher once you want to make it a fully regulated, your own stablecoin, but not where you just want to make it for your own little, kind of world that you're controlling.
With the Genius Act passed and many institutions are approaching you now to figure this all out, what's their level of urgency? Is it we want to dip our toe in the water, or we need to plunge in because we're worried about disruption?
It's interesting. I would say it's generally plunge in. But it kind of depends on the institution and what plunging in would mean strategically. So if you said, we need to be able to launch crypto, buy, sell, hold, there are a number of institutions that are just saying, well, plunge in. It's clear, you for the next 3.5 years, you have regulatory certainty, you have, policy certainty. That creates a really clear playing field in which you can invest in. And the asset class isn't going away. So you're like, well, look, we just got it. We just have to do it. And they're just in. And it's really not that complicated because say you have a high net worth or private client business or a retail client business, you just need to add another asset in there that they are able to trade. They can trade stocks. Now they can trade some crypto assets. And maybe just start with Bitcoin and Ethereum. Not even that controversial.
Sure. Plunge
into that, right? And you might even be saying, I'll plunge into allowing stablecoin funding too for I've enabled crypto buy, sell, hold. Where it might get a little, someone get a little more cautious is where it could strategically impact the core business. So say you're a core transactional bank. Stablecoins could have like some nonlinear outcomes to your business. So you need to be very strategically aligned on what you want to do. So it's not so much that they're not going fast, but they're trying to be very thoughtful about making sure that they're taking the right steps. Because if you just plunge right into something where it could undermine or completely shift your business model,
right.
You want to be very thoughtful and prepared.
Sure.
That's kind of measure twice, cut once. It might not be a one-way door. To mix a lot of different metaphors altogether. But anyways, or euphemisms. So I think but I think it's very clear all of them are very focused on this. Genius is very important because it helped make there be clarity around what you can do in the stablecoin space. The clarity bill is, the next thing that is really needed. I mean, it's going to create clarity on what assets are what.
Yeah.
And that will matter because I was talking to one of the DeFi exchanges on Solana, and they were telling me how they add 35,000 assets a day. A day. So no one's going to add 35,000 assets in a day.
Right.
There's millions and millions on, say, Solana just alone, right?
Yeah.
It's unbelievable the Cambrian explosion you've had in assets. But you're not just going to add only Bitcoin and Ethereum. You're going to add more.
Yes.
This is a real asset class. You need to make it available. Having clear roles and rules. What can you do? Who can do it? Is it a security? Which regulator is involved is certainly needed in order to make this more broadly available in the financial ecosystem. Obviously, everyone can go to a Coinbase in the US or a Kraken or a Gemini or whomever and be able to buy and sell a lot of assets. But you can't do that in maybe a lot of traditional financial institutions.
But also, do you think in the stablecoin world, which blockchains do I put my stablecoin on, right? Which blockchains are okay? The clarity I can give that guidance.
Certainly, yes. Well, because the last thing you want to do is put your stablecoin on a chain where it's a security.
Yeah.
And so now you have securities laws that you might come into play. There could not be enough decentralization or other things that might undermine the ability of that chain to succeed.
Right.
And so we're an infrastructure provider. So in some sense, we're going to put assets onto chains that our customers want.
Right.
But on the other hand, you have to also be forward thinking and help guide the conversation. And so you want to make sure that, when you do, and everyone has to do this, you do these risk assessments. Okay, well, here's why this thing makes sense. And because we're a regulated issuer, we submit those and we do all this work on them. And it helps to have those chains create a level of confidence and imprimatur of like being trustworthy. And if you don't know what those rules are, it kind of makes it a little tricky and a little tough.
For sure. Do you anticipate, this is a hard question, the Clarity Act gets passed this fall and then we see this massive boom in innovation?
Absolutely. I mean, I think you're seeing it now, by the way.
Sure.
But there's still some uncertainty of how you would handle that. So, handle like the innovation that's happening, because someone wants to create a foundation, and so they're doing it on some offshore entity, and then they create a labs entity. Like, can you collapse all those things down? There's certainly like a school of thought that you can now, but certainly with the right rules set into place, then you can have the confidence, if you're a developer sitting in the U.S., not to have these offshore entities, not to hire people offshore. You can bring this innovation back into the U.S. market. Really, there's ways you've been able to create the possibility of decentralization over time.
Right.
Now you'll have a legal process to be able to do it.
Right.
That exists in the United States. And that really hasn't been here before. So I think you'll see, just a whole new wave of possibilities that come into be, because you don't have the friction of the cost of maintaining all these different entities and all these different things. I think everyone I have talked to says, it's really clunky. You have a foundation, you have a labs. How do you do this? How can you use like the concept of it's centralized over time, it decentralizes, or it is decentralized already at the very beginning? How can you use that ability to create network effects through having shared economics from the very beginning really work for a wide range of business models? And in some sense, we've had a bunch of examples of where that has succeeded, mainly in chains and some other areas, but it hasn't truly been unleashed, I think, yet.
So on that note, I want to double click on the collapse possibly of labs and foundations and maybe just a traditional business model, but there's more transparency with the regulator. Maybe the coins are in a smart contract or some sort of treasury, but we don't have to worry about the foundation, the labs, and all these things.
I think that's the problem is in order to create enough separation, you end up creating a lot of opacity for token holders. It's certainly something you could overcome, but you can't overcome it in hundreds and hundreds of cases. I mean, people only have so much time.
Yeah.
So you want to create standardization, right? I mean, like I remember when like VC fundings, everything was like bespoke, right? And now you have like these safe notes. You just try to make things standardized so that you can modularize and have building blocks and pieces. And so, there's kind of a unknown system now between labs and foundations, et cetera, but it's clunky and it's complicated. And if you're outside, like you might not truly understand what's going on. Whereas now you have rules that are set up, there'll be some way you matriculate through the system from centralized to decentralized. This is your regulator. This is what you do. This is how you make the disclosures. Everyone does it. And, that creates liquidity and consistency and a simple set of knowledge base for the market to be able to function off of.
Sure. Yeah, that definitely makes sense. And I'm curious to see what the SEC comes up with. I know the SEC and the CFTCs, they've been doing a lot lately, crypto sprints and much more. And I know there's a crypto task force meetings with a lot of folks. Have you guys met with the SEC and things like that?
We have met with the SEC about a bunch of different things. I think, there's so many ways in which this can unfold for both stablecoins and for traditional crypto assets. And, you don't want to have dual registrations. That'd be a little clunky with the SEC and the CFTC. You want to, maybe be able to do one and have it like work with something else. Or there's been talks of, would you combine these agencies together, or could you have one person who runs both of them? Or, just there's different ways in which you try to simplify things, because we're getting into a place where the river hits the ocean here between securities and non-securities. How do you handle that in a way that is not really cumbersome and makes things harder?
Right.
I think there are other examples of things like yield-bearing stablecoins that have been a little hot to the touch. That I think are really important innovations that are inevitable. It's such an interesting thing, stablecoins and yield-bearing stablecoins. The SEC has money market funds. And a money market fund is basically a stablecoin. It just only can trade on an exchange from 9:30 to 4, right? I mean, but it's basically, and so it has limited utility outside of an exchange. You certainly can't use it for everyday payments, but it pays interest, and there's like $8 trillion of these. And it's not destabilizing the system or whatever. I mean, and so there should be a way that if you're lending money to the U.S. government through some common pool, that you should be able to get the interest back. You know what I mean? It's like a little crazy that, only banks can pay interest on things.
I was going to ask you about that.
Or a deposit.
Because in the Genius Act, they left out the yield bearing. So was that to protect the banks? I know that's a controversial question and topic.
So the way Genius reads, and this is our, I think, clear understanding of it, you can't pay interest to the end user, right? But you can pay interest to a distributor or intermediary, and then they can pass it on to their end user in whatever way they want, as rewards, as airline miles. They can pick whatever they want. They pay it to their end user. It can be a different amount. It can be for all kinds of different things. It can be trading credits, whatever it is. And that's what's going on today. I mean, Coinbase is paying a big yield right now. PayPal has been out publicly talking about how they pay yield. Lots of institutions paying yield. So that's not like a crazy thought. I think there was a world where everyone went to a bank, and so a bank had a banking exemption from being a security.
Right.
That was the whole point. But remember, a bank deposit, we should just throw the word deposit out. It's such a confusing term.
Yeah.
All it is a loan. You have made a loan. A loan is a security. If you basically loan money to a bank, they don't have to give you any disclosures because they're highly regulated. Right. Whereas if you loan money on a consistent basis, that's a common offering, you have to do a securities filing. Banks have a bank exemption. That's fine. We get why they have an exemption, but it shouldn't be that it's an exclusion for other people, right? And part of the reason why the banks have exemptions is because they're highly regulated. You lend them money, they don't even necessarily pay you that much interest.
Sure.
Right?
Yeah.
But they're probably riskier than the U.S. government.
Yeah.
Except if they're too big to fail, then they are the U.S. government. Maybe everyone's too big to fail now. But in any case, if you lend money to a bank, it's called a deposit, but you get some interest rate and you can withdraw whenever you want.
Right.
If you lend money to the U.S. government, it's somehow called a security and you can't get paid interest. If you do get paid interest, it would be a security, but if you don't, then it's not a security. That would be a stablecoin. Or you can lend money to the U.S. government in a money market fund, and then that's a fine mechanism, but it can only trade on a New York Stock Exchange or a stock exchange. So these things are really convoluted because of the weight of history, and they really should be addressed and common sized. Of course, banking institutions have a lot of incumbency, and I could understand why they feel like they're heavily regulated. So how are you going to let in institutions that are not regulated? But now with the Genius Act, stablecoin issuers are regulated just like banks. Yeah. They're regulated just like banks. And in some ways, a stablecoin is the safest dollar you can hold in the whole world. Because if you hold a money market fund, which is kind of a dollar, they go buy T-bills, they actually can hold 5% in things that are not in dollars. They can hold things that have longer maturities. Sure. A stablecoin issuer can only hold in 3 months or less T-bills, overnight repo, and bank cash. And so, like a short-term repo. That's actually more restrictive than a money market fund, and it's also more highly regulated because you're issuing from a trust.
Trust, yeah.
Which is a banking institution. So it's safer than a money market fund. And it's also safer than a bank because they're not making loans to, subprime housing or some securitization or who knows what, a personal loan. There's no loans that are being made if you're a stablecoin issuer aside to the U.S. government. It's the only thing you're doing. And because you're issuing it from a trust, you're just buying the security of the U.S. government. There's no risk to the issuer. You're not a general creditor. When you deposit money at a bank, when you loan money to a bank, you are a general creditor just like anyone else who loans money. Right. And this concept that stablecoins are scary, they're actually the least scary thing in the financial system. Right. They are non-fractional money that is more prescriptive than a money market fund and more regulated.
Yeah, you get away from the fractionalization, banking and all that.
I think that's one of the biggest advantages is we can now finally have a financial system that is not based entirely on fractional money.
Yeah.
And that has created too big to fail. That has created systemic risks. That creates bank runs and accelerator effects. And so you can now have the payment system be fully reserved through stablecoins. Right. And you can have the banking system lend money, or the lending system have fractional elements to it. And we even see this in DeFi, by the way, with looping strategies. Right. So you can have a fractional system, but it's very clear that the base of that system is not fractional. Right. The base of that system is fully reserved. Today, the base of the banking system, aside from cash that's in your pocket, is electronic money that's all been fractionalized. You can't hold your money anywhere else. You can't have a payment system that isn't using fractional dollars. Right. Now you can. You can. And so this is actually a huge innovation that allows, I think, a separation of church and state, fractional and non-fractional, in a way that creates more safety and soundness. And eventually, you should be able to have yield on this non-fractional asset because it's just you're lending money to your own government. You should be able to get the interest rate on it as easily as possible. I think that's a winner on a political basis for consumer benefits across the board.
Yeah, and it fixes maybe some of the legacy problems of, like you said, too big to fail, right? Maybe these are problems of the past, and we have the technology, we have the verifiability, the transparency now to build a better system. And on that note, it feels like this is another Bretton Woods moment, a change in how currency is handled and the dollar as well. And then if you want to call the Nixon era where he took the money off the gold standard, this feels like one of those moments. And then with the US dollar, also you mentioned with treasuries, we're now no longer maybe as dependent on China and other countries, Japan, to buy our treasuries, but we got stablecoin issuers to do it.
I think it's so fascinating because I think there's a couple things going on. There was this thing called the Big Bang, which was like deregulation of the financial system that happened in the 80s, and it kind of like created like the junk bond market and all kinds of trading of new assets and things. Sure. And so I think in some ways this is like a Big Bang 2.0 because when you get the Clarity Act back, that'll be Big Bang 2.0.
Sure.
And maybe the Genius Act might be looked back as Bretton Woods 3.0 because you now had the capacity to finally democratize access to central bank money. And so when I say central bank money is like cash in your pocket. There's no real liability to cash in your pocket.
Right.
There's no counterparty risk. You have it.
Sure.
It's issued by the central bank.
Right.
Banks have central bank money. They're called Federal Reserve dollars. They're the only ones who are allowed to hold these things. They're basically reserves.
Right.
And so they hold them at the Fed. No one else can get access to them. It's only held through the banks. And so that's why you're always tied in the fractional banking system. Now, stablecoins are fully reserved dollars that anybody can hold. And I think that's a huge innovation in the financial system, and that's why stablecoins have two benefits to them. One is that they're a better rail. That's because blockchain's a better rail.
Right.
So dollars are on a blockchain. It's a better rail. It's 24/7. It's instantaneous. It's basically more or less free. Almost a penny or less. It's fully programmable, which matters a lot in the future, agentic economy, and it's transparent. So it's a better rail. That's what blockchain is. But because it's a fully reserved dollar, it's also a unit of account. So you can now hold a fully reserved dollar on your phone or your iPad or whatever you want, and you don't need to have a bank account anymore. So you're able to have an account structure and a better rail at the same time. And that's been codified into law. And so that allows you to build business models in a way that didn't exist before in the financial system.
Right.
And I think that's really powerful for the dollar.
Yeah.
I think that is going to lead to the dollarization of the world in a way that we haven't even expected. There's $100 trillion of M2 in the world. $22 trillion of them are dollars. So there's $100 trillion in total. It's growing 10% a year. So that basically means it's like $150 trillion in 5 years. And how much more dollars can now exist because of that M2 because of stablecoins. A lot more, trillions and trillions more. That's a good thing because we have a lot of debt to issue. It's a bad thing because it enables us to issue a lot more debt.
Right.
You know what I mean? Which we probably shouldn't be doing.
Right.
So in some ways, this could enable the dollar to be unsustainable even longer. But you got to solve one problem at a time. And so you dollarize the world. That's a good thing for issuing U.S. dollar-denominated debt. Maybe at some point you say, you know what, a dollar isn't only backed by U.S. government debt, it's also backed by Bitcoin. It's also backed by gold.
Yeah.
I mean, technically the dollar still is a little bit backed by gold because it's on the Fed balance sheet now.
Sure.
But, practically speaking, it's mainly treasuries. Sometimes the dollar's been backed by Civs and Maiden Lane and all kinds of junk bond assets that they bought in different crises. So, the dollar's been backed by a lot of things, not just treasuries. A stablecoin is actually in some ways even safer than money that's been issued technically by the Federal Reserve.
Maybe the future generations can solve this problem with the baseline that we set.
I wish it was going to go to future generations. I suspect we're all going to have to live through this difficult state of times ahead of us
for sure
together.
Now, with regards to demand for stablecoins, is it primarily around the U.S. dollar, or are folks also looking at, hey, we want to do the U.S. dollar, but we also want to do a digital euro or whatever it may be?
This gets asked all the time, and in some ways, I've been puzzled by it, but that maybe the narrative that would backward justify the fact that the $260 billion of stablecoins, 99% of it or more is U.S. dollars. There is certainly a benefit to scale, but I also think everybody wants dollars. Yeah. And if you're in Europe, you have access to euros. And they have good rails. They have real-time payments.
Sure.
If you're in Singapore, you have access to Singapore dollars. They have good rails. If you're in China, you have access to yuan. They have, very good rails. The U.S., we don't have very good rails. It's even worse rails if we try to move dollars outside the U.S. The dollars are the lingua franca of the financial system. 80% of FX transactions have the dollar on one side. So everyone's using the dollars. It is used, as the universal currency, but it has the worst rails. So on the one hand, you need better rails. Blockchain rails are better than what we have in basically the dollar financial system. You don't have that problem in other places. So there's a need to get on for a better rail in certain use cases. Not if you got to go down to the grocery store and buy some groceries in the suburbs, but if you want to send money cross-border, and that could be consumer remittances, it could be business payments. If you need to do FX transactions, that have to touch dollars. If you're a holder of dollars outside the U.S., you need to be able to move them around fast. There's lots of leads and lags. And the other issue is people all want dollars and they can't get them.
Yeah.
If you're in Argentina, I don't know anybody who goes, I really want the euro.
Yeah.
So then you would need a euro stablecoin because it's a unit. It's a unit of account.
Right.
Account structure, and it's a rail. So I don't know anyone in Argentina. They all say they want dollars. How are you going to get dollars? Well, it was physical cash. Now it happens to be Tether. If you're in Turkey, maybe there's a little interest in euros, but it's really dollars. If you're in the Philippines, you want dollars, right?
It's true.
Nobody wants euros, let alone does anyone want like the pound or the Swiss franc or, and then you go down even further into like really off the run currencies because there is some reserve elements of euro or pounds or Swiss francs, but not enough because those are big institutions. They just hold it the normal way.
Right.
You get to the consumer level person or the business level person that has to do transactions, it's all dollars.
Dollars, yeah.
And they don't have access to dollar accounts. So a stablecoin solves something for them, right? If you basically are like, well, what's the unmet need? The unmet need is I can't get any dollars. I want a dollar, right? Or I can't get what currency I want. Which one is it? It's the dollar, and then I can get a stablecoin.
So Charles, the clients that work with you, like PayPal and others, is there a strategy to go to these countries in Latin America, maybe Africa, and it's not set up a bank account or set up an account, but download my app and set up a wallet so that you can transact with these stable coins or access crypto? It's like more of wallet based versus account based.
I think you're seeing a lot of that. There's a lot of firms. You can imagine if you're like a company, you could easily have a wallet installed automatically in any one of the different phones from the phone makers. I think if you are a financial institution and you're kind of only in one jurisdiction, you can now make a wallet available for anyone to be able to download and be able to hold on their phone. So you have this capacity now to, it's called a wallet. It is a good analogy. It's basically, you can have a digital wallet now that you control.
Yeah.
And, that could be associated with another financial institution, but you control it. And so you can create a lot of functionality for the end user without them having to be in your system because they'll be on their system. And so you're creating new ways of interacting with customers that haven't existed before. Previously, if you wanted a PayPal account, you had to be on PayPal. Now, maybe you, as an example, could have your own wallet that's associated with your PayPal wallet, and you can move funds right into it. And the same thing kind of go on and on. Sure. Companies that weren't even financial institutions can now offer what would be a self-custody wallet.
It's fascinating. It's how do you see this playing out with a lot of these issuers, everybody trying to get their stablecoin in the market? Will there be some consolidation eventually because there's too much saturation?
I think you always end up consolidating as you get later in a cycle because the cost of organic growth is more than the cost of inorganic growth, because you can basically buy businesses and you cut out all the costs and you keep the customers, right? But I think you're at a moment now where the cost of organic growth is less than the cost of inorganic growth. There's a lot of high valuations for businesses. So you look at what the valuation of businesses versus you going out and just growing your business through natural organic activity. And that's the better ROI right now. So different parts of the product and industry cycle create different situations. I mean, like think about the airline industry. There's so many airlines like 30 years ago.
Yeah.
Now there's like 4 or 5 of them.
Yeah.
I mean, like,
Makes
so
sense.
the best way for them to be able to grow was to consolidate. I mean, that's why you end up having antitrust laws or whatever it ends up doing, because then there's no competition. They just jack up prices.
Right.
But, there is an element here of where you're at in the cycle. I don't think that's where we're at today.
Sure. It might be like 10 years from now.
It could happen fast. It could happen slow. I mean, it's going to be
Sure.
tough. I mean, what's really a wild card that's hard to handicap is AI and, agentic commerce, agentic activity. If everyone in 5 years might have 50 or 100 agents working for them, how many of them are going to have wallets?
Right.
How many? So, I mean, you're not limited now by the number of people.
Yeah.
You're limited by the number of agents that a person is going to have to be able to activate and use. Clearly, they're working for a person, but it's going to, even proliferate more, and how you would use it will completely change.
And not just the AI agents. I just interviewed the CEO of OpenMind. They're building like an Android software for robots. The humanoid robots are coming, and that robot has 3 crypto wallets built into it, and downloads its constitution from an Ethereum smart contract. So if I eventually, 10 years from now, Charles, we have humanoid robots in our home, go to the store and get me something, it's not going to pay with cash.
Yeah, so Isaac Asimov is coming here faster than we thought. It's unbelievable to have the 3 laws next. But, it's pretty cool what's going to happen. And till who knows? There's a reason all these science fiction movies always end up in a war with the robots. But anyways, it's certainly going to proliferate the need for both stablecoins, a internet-based financial system. I think that logic is more true than ever. I mean, if you basically step back and you basically said, you should have all assets be freely accessible to everybody, obviously in a trustworthy way, but all assets should be freely accessible for everybody on a global basis.
Yeah.
And, if everything's moving on in an open internet-based system, why wouldn't the financial system move that way?
So Charles, you were mentioning 5 years from now, 2030, I walk into Starbucks. Am I paying with a wallet that has stablecoins, or am I still using a credit card powered wallet, but in the back it's using stablecoins? But as the end user, I don't care. TCP/IP, I don't need to know the functionality, the pipeline. I just need to know it works.
Well, first of all, I agree with you. You don't need to know if it, TCP/IP or what database you're using in the background. I don't even think you'll know that you're using a stablecoin. It could be. It's kind of like what habit do people have in 2030? I think that's always very hard to tell because it's harder to shift than you think. But the underlying rails will almost certainly, I think, be a stablecoin then. It could be, you might be using your debit card and it's just pulling right from your exchange or whatever wallet, bank account. Exchanges and all these firms are basically banks. They'll all become banks in the future or something like it, or have bank arms. They're just building up from a different direction, but it'll all end up looking the same. Whether it's a Revolut or Coinbase or whatever. In my opinion, they're all kind of like a bank functionality.
Oh, sure.
Which is like, we hold your assets. You want to go spend your assets. You're going to go spend those assets to buy things like goods and services. You're going to go buy assets, but it's going to be a universal application, and everyone's basically putting that into place. And you're not just buying or selling or holding it. Sometimes you want to lend it out, and there you have it. You basically have like the equivalent of like a full service institution, and that's where crypto has created inroads into the new generation. That all these traditional institutions, by, in my opinion, fighting it, completely put themselves in a terrible position, because now you have hundreds of millions of customers that have gone into the crypto ecosystem with crypto wallets. They have to all play catch up to where the world has gone and how the new generation has shifted. And they're actually way behind the 8 ball because of that. And so when you then fast forward to the genesis of your question, which is, well, what are you going to pay with? Well, if everybody is, essentially using a Kraken, Coinbase, Gemini, Revolut account, whatever, pick your company.
Sure.
They might, it's going to be on your phone. You have your wallet, you tap and pay with your phone.
Yeah.
So you might not pull out that card, but you got a lot of there's a long tail people, maybe everyone's not going to have that. They're going to need a card for certain merchants or whatever. So they could issue a card too. And you can have a card and you have your phone and, pick your poison.
And on the flip side of that, Charles, if I have instant settlement with payment and I don't have to wait for settlement from a bank or whatever, and I don't need a credit line to fund payroll, can I pay people every day? They go straight to their wallet, their paycheck.
There's really no reason why you couldn't pay every single day. I mean, there's historical reasons why you couldn't pay every day, but you absolutely could pay everyone every day. Why you gotta pay every 2 weeks? You're right.
Right.
There's all these things that had built-in lags were for operational reasons.
Yes. Yeah.
There's no like economic reason why it needs to be that way.
Right.
But you might not be collecting your revenue every single day. So if you collect revenue every single day in real time, you could pay some expenses in real time. There are like some leads and lags. Some businesses, would then need to like fund that payroll if they're paying it every day because they haven't collected all their revenues.
Oh, sure.
Right. So there's like some elements of like,
or a
where's
day
real
lag
time?
or 2 day lag maybe.
Or just what's real time, what's not, how does it work? I think there'll still be the need for credit. You'll just be able to access it in a different way than you have before. You can imagine a world where why do you need a credit card if you can do buy now, pay later for basically anything, and you have stablecoin rails?
Yeah.
Stablecoin rails plus buy now, pay later equals why do you have a credit card going through, a traditional, payment network?
Sure. And this is a controversial topic, but it seems the technology is here to handle this problem. There's talks of UBI possibly in the future because AI and robotics are going to take a lot of jobs away. And not everyone's going to be able to have the same jobs they've had now and in the past. But with stablecoins, the government can send money directly to a wallet.
Yeah.
Do you think that's a possibility?
Well, it certainly makes it easier. You could have done PPP loans and a whole variety of things better if the government was using, verifiable wallets that they were sending stablecoins through, not a CBDC. Right. But on the other hand, I don't know if that's what will end up happening because, if you look back, 100 years ago and you basically said this is what the world would look like. And, oh, yes, we're spending all of our time worried about how to create a stable coin. Look how wealthy the world has become.
Yes.
It looked like we're playing trifling games. Right. And would it certainly look like that 500 years ago or 1,000 years ago, but we find new ways to keep ourselves busy and come up with ways to create economic value and solve problems. Now, I think you could maybe have dislocations in the labor market, but my suspicion, you never know, it could be different this time, is that it'll look like other waves of innovation. You look at the construction economy today, it's 20 times more productive than the services economy. And so I think of software as basically the construction equipment for the services economy. So now you're just getting automation and no one's like, oh, I wish everyone was digging ditches with a shovel. Right? No one complains about that. Those jobs went away. New jobs showed up. Anyone who's working in a steel mill wasn't like, oh, I want my kids to work in a steel mill.
Right.
You talk to them, they were making good money, but they said, I want my kid to go, be a teacher or go be a lawyer or be a doctor. I don't want him to work in a steel mill. And now you're going to be like, well, why was I making them sit there, look at the computer all day long doing this task that was so repetitive? I want him to go do something different.
Yeah.
And they're going to be able to go do something different. I actually think that's what it'll look like. And so we only can understand a set of problems based on the perimeter that we can see. But I actually think that the possible solution set is infinite. And we're looking at a finite set that we have drawn and basically said, I don't see the solution in here. I guess it's going to end up being Malthusian. But it's actually infinite possibilities. And we'll come up, therefore, with infinite ways of doing things in the future that will use people.
Yeah, that definitely makes sense. Well, we always find new avenues, new roads, and new ways to be creative. And
it's happened every single time. I mean, maybe this time is different.
Yeah, we'll have to wait and see. I wanted to talk about the tokenization market because aside from tokenizing dollars, you're also tokenizing gold. And I want to get your thoughts on updates there, but also what's next? Real estate? What else do you see getting tokenized?
Well, we definitely have tokenized gold now for a long time. We have it just hit $1 billion, I guess, yesterday.
Wow.
Not necessarily a good sign for the dollar, but gold hit an all-time high. We're almost at an all-time amount of ounces. And so the $1 billion gold stablecoin is something we're really proud of. I certainly think there should be more assets that are tokenized. It's basically the largest non-dollar stablecoin that's a real asset is our gold stablecoin. And, I think there should be more. I mean, silver's always been a small market, but that's a logical thing is to do silver and then maybe platinum and palladium.
Sure.
But those gold is really a pretty giant asset class, like 20-some trillion dollars, whereas silver is a little bit more of an industrial metal, and it's smaller.
Sure.
It's really more about flow as opposed to stock.
Right.
But still, like, held for monetary reasons and for a lot of historical reasons. I think that you're seeing a lot of conversation around equities. People tried to do real estate in the past. Real estate's a big equity, a big market cap.
Right.
But it's not all that standardized. So when I think of the adoption curve for real assets, there is some combination of what is the size of the market cap, like you could look at gold, $20 trillion, and how fungible is each unit of it. So you could try to create, like, this building is not fungible with another building.
Right. Yeah.
At least we haven't figured out a very good way to do that. You try to kind of do it, but it's not all that simple. And so it's not that real estate's not a big asset class, and it's not that you couldn't solve a lot of problems by essentially putting chains of title on and being able to understand interest payments and solve a lot of operational complexity by putting it on chain.
Sure.
It's just that what tends to get pulled on chain is where you have ability to create liquidity. And it has something that's big. It's so that liquidity that you're creating is meaningful enough for people to try to drive it.
Yeah, because while I think globally we recognize stocks, gold as these assets, but real estate, I don't know, not everybody may want to invest in real estate or real estate in certain places, because I don't think it's possible to tokenize every jurisdiction. Maybe it is in the future, but
you could go to all the land registries in every county registrar, and you could put them all on. And you can do that for cars too, by the way. And I think that's great, but you're solving, I think, a little more operational complexities.
Sure.
That will lower friction, lower costs. It will make things better. I think it's like a very real use case for it.
Sure.
But
like liquid markets, maybe not, right?
I think it's a little bit like, so if you basically told me, okay, you tokenize Apple or Tesla, one of the Mag 7, and trillions of dollars market cap in each one. And you're in Brazil, you want $1. What do you want to do once you get that $1? Well, I'm going to hold that $1. Well, maybe I want to own a fraction of an Apple share. So by tokenizing Apple shares, you could create much wider ownership of maybe the top 10 or top 20 companies, which is basically, by the way, like half the S&P anyways. So you're like, well, or you just tokenize the S&P, and you'd be like, well, you know what? I couldn't get access to Apple stock, now I can. I couldn't get access to dollars, now I can. You probably also be like, I wish I could get some access to some yield, and you want to, a yielding stablecoin, or you want to be able to put into a lending pool. So I think those are kind of the things where you see the liquidity benefits and an unmet need happen. Whereas I don't know that if you fractionalize this building, what is exactly is the unmet general need you have. I think you're solving some problems for the owners, but maybe not in the same pressing way that you have by tokenizing dollars or even tokenizing some of the largest companies in the world.
Yeah, that definitely makes sense. I wanted to ask you about your application to in looking to convert the NYDFS trust charter into a national charter under OCC. What that mean? What that will mean for your business?
So there's really a couple of different ways that you could create a national trust. One, which we did before, was submit a de novo application. De novo means basically new, from new in Latin. And you could do a conversion, which is the other way, which is take the one you have and you can convert it. And so there's like pros and cons to each thing. But every time you have a new regulated entity, there's more costs. And there's more complexity, and you have segregations that you have to do. So it is not always easy to just create new regulated entities. We've tried to do that in jurisdictions that are outside the U.S., not so much in the U.S., though we did that in the past because we thought it would be simpler. But I think with the passage of the Genius Act, it's pretty clear that you have stronger benefits to being an OCC trust because you don't have to go get a waiver from the state regulator. It's a higher standard to have an OCC regulated trust as a result. And so just converting the one we have makes it easy because you literally just take what you have, and instead of the New York being the regulator, the next day the OCC is the regulator, but everything else stays the same.
Sure.
And so that's easy. And, we really look at that as a way to make sure that we're meeting the highest regulatory standards, which we've always tried to do, and do it when that is available.
And on that note, anything on your roadmap you want to highlight that we can expect in the coming months or so?
I think the most exciting things that we're seeing are the adoption of stablecoins and the adoption of crypto brokerage. So we talked a little bit about how everyone wants to launch, buy, sell, hold.
Yeah.
There's going to be some great big customers that are going to come online that everyone will find very exciting towards the end of this year, maybe beginning of next year. And then on the other hand, we look at what's going on in the stablecoin world, and obviously Tether and Circle have the biggest market share today since we had to wind down our Binance dollar.
Yeah.
And we're in a position now, though, where I think some of the stablecoins that we have in market are in a position to really grow and take market share and kind of reclaim the position that we had in the past, which was, really on par. I think, if it was around today, it would be the winning stablecoin.
Any chances of relaunching that Binance US dollar?
That I don't think can happen, for different regulatory reasons.
Okay.
But I think we're in a position with some of the products we have in market now to get to that type of scale.
I'm very fascinated by the global dollar network, just because the consortium, there's so many big players and they have the distribution. So I've been watching that one closely.
Well, I think it's a very unique model because part of the reason why you want to have your own stablecoin is because you're not just getting the interest on your own balances. That you can get anyways.
Yeah.
You're getting the interest on the balances that other people are holding that are not in your system. So that's why you really want to have a white label because otherwise you're not really doing anything except for maybe simplifying your internal books and records. Sure. So you want to have it because you get the off-platform interest, and that's what's very powerful for Coinbase with USDC.
Yes.
As an example.
Right.
And that's of course also the cost to everybody else.
Yeah.
With USDG, it's set up where anybody can join. It's not exclusive. You can use any other stablecoin you want to, but you join. You have $100 million of balances, you get the interest on that, less our asset management fee, which is about 30 or 40 basis points. And you send that out to somebody else, and let's say you send $50 million off to somebody else, now you only have $50 million of balances, but that other person is not part of the global dollar network. And guess what? You can get the interest on those balances. So you get the interest on balances that are not on your platform if they're not in a global dollar network member wallet. And so you will still earn the interest as if you had $100 million of balances, even though you only have $50 million in balances. So you're getting the benefit of the off-platform that you created. And we do that by looking at net minting and making sure there's no double counting. But the point here is that network effects can accrue to everybody that joins the global dollar network, not just to one company or not just to some companies. It benefits to all companies. And I think that's a very novel way of approaching this because you have a network effect problem when you're launching stablecoins, which is how do you get people to want to use it?
Right.
And you can pay them for their own balances, but the real kicker is you can pay them for balances that they're responsible for creating. So you, in this case, might only have $50 million on your platform. You have another $50 million you created. You're earning as if you had $100 million of balances. Wow. So you're earning more than the risk-free rate on the balances that you're holding because you're earning, double in that case.
Right.
So you go out and create a lot of balances, and they're not on your platform. You're getting paid as if they are. And so I think that's a very powerful economic alignment mechanism. Sure. And that's certainly why we've seen such a large uptake. 67 institutions have joined now because it creates the federated economics of a white label.
Yeah.
And that's why it's called the global dollar.
Right.
We issue the global dollar for the global dollar network, just like we issue for any other single firm.
Right.
It just happens to be a group of companies. And so I think there's a lot of interest in being able to get the benefits of your own stablecoin.
Right.
without having to go through all the work of creating your own stablecoin, because it is hard to do.
Yes. Yeah.
If you're trying to get to scale.
Yeah, that absolutely makes sense. Final question here, Charles. A lot of companies going public. Circle, most recently bullish. Does Paxos have any plans?
No plans today. I think plans in the future, but not plans today. I think right now our goal is let's be heads down. Let's do the best job we can for our customers. There is an enormous amount of opportunity here, and going public is not easy to do. It does create a lot of distractions. It creates a lot of benefits. I think there's a time and a place for everything. I don't think the time is now, but the time is in the future. I mean, I think there really is a much different approach in this administration to getting public and what the opportunity is if you are public. And it's something that we're definitely watching closely. I mean, it's been really exciting to see how many companies have been able to come out and what the receptivity has been.
Yeah, it's been amazing. Charles, always a pleasure. Great stuff. I'm looking forward to those updates come later this year. And maybe
yes,
we have to
have
have
a lot of fun.
On.
I'll come back in. We'll talk again. I know.
Yeah, for sure. Thank you so much.
I'm looking forward to it. Thanks for having me.